In 1972, the smartest money managers on Wall Street all agreed on 50 stocks. They called them the Nifty 50, companies like Xerox, Polaroid, IBM, Coca-Cola. Household names with proven growth records, rising dividends, and seemingly unbreakable business models. The average price-to-earnings ratio of these 50 stocks reached 42 times earnings, more than double the 19 times multiple on the broader S&P 500. But the institutional investors buying them didn't care. Morgan Guaranty, one of the most prestigious banks in the country, had over 30% of its equity portfolio in just these 50 names. Quarrel Hathaway, a senior vice president and Morgan Guaranty, said publicly in March of 1973, and I want you to hear this exact quote: "The greater fool in growth stocks isn't the one who buys them, but the one who sells them." These were not amateur retail gamblers. These were the most educated, most credentialed, most experienced financial professionals in the world. And they had consensus. Wall Street called the Nifty 50 one-decision stocks. You buy them and you never sell. That was the standard operating wisdom from the smartest people in every room. Then, between January 1973 and October 1974, the S&P 500 fell nearly 48%. The Nifty 50 were demolished. Polaroid dropped over 90% from its peak. Xerox was gutted. The period became known as the Black Bear Market because it didn't just destroy portfolios. It convinced an entire generation of well-educated Americans that equities were dead. For the 15 years from 1965 to 1980, real inflation-adjusted returns for investors were approximately negative 10% annualized. Not flat, negative. The most sophisticated financial minds of a generation had built an airtight consensus, and that consensus was the trap. I'm telling you this because the exact same structural flaw is currently hidden inside the financial decisions of most educated households in this country. The mistake isn't ignorance. The mistake is confidence. And here's what makes it so dangerous. The data proved that more knowledge, not less, is correlated with worse investing outcomes. Not because knowledge itself is bad, but because knowledge creates a specific behavioral pattern that the financial system is mechanically designed to harvest. In 1979, Daniel Kahneman and Amos Tversky published their Nobel Prize-winning framework called prospect theory. The core finding was this: human beings feel the pain of a loss roughly twice as intensely as the pleasure of a gain of equal size. That asymmetry, loss aversion, is hardwired. It is not a character flaw. It is the operating system of the human brain. And here's the critical secondary finding most people never hear about. The more informed the participant, the more likely they were to believe they could outsmart the asymmetry. Education doesn't override loss aversion. It masks it. It gives you a narrative layer, a story you tell yourself about why you're selling, why you're switching, why this time the rebalancing is rational, that obscures the fact that you are doing exactly what the least sophisticated investor does, which is react to fear and greed, but you're doing it with a vocabulary that sounds like strategy. Brad Barber and Terence Odean at UC Berkeley studied over 66,000 household brokerage accounts from 1991 to 1996. Their paper, Trading is Hazardous to Your Wealth, published in the Journal of Finance in 2000, found that the average household turned over 75% of its portfolio annually. The most active traders, the top 20% by trading frequency, earned an annual net return of 11.4% during the period when the market returned 17.9%. The least active traders merely matched the market. The conclusion was blunt. Overconfidence, not a lack of information, was the primary driver of underperformance. The people who traded the most believed they knew the most. And that belief was what destroyed them. DALBAR, an independent financial research firm, has tracked this phenomenon since 1985 in its annual Quantitative Analysis of Investor Behavior report. Over the 30 years ending in 2024, the average equity fund investor earned roughly 3.5% annualized. The S&P 500 returned approximately 10.2% annualized over the same period. That is not a rounding error. That is merely a 70% reduction in the rate at which your money works for you. And the most revealing finding from DALBAR's 2025 report is what happened in 2024 specifically. The S&P 500 returned 45.02%, and the average equity investor captured only 16.54%, an 8.48 percentage point gap, the fourth largest since DALBAR began tracking. This wasn't a crash year, this was a boom year. Investors underperformed the most in the year it was easiest to succeed because they couldn't stop touching the controls. Think of it this way. There is a high-speed freight train running on a perfectly straight track. It has been running for 100 years, and its long-term average speed is roughly 10 miles per hour. Not glamorous, not thrilling, but over decades, it covers an enormous distance. Now imagine a well-educated engineer standing next to that track. He's read the manual. He understands thermodynamics, friction coefficients, load distribution. And because he understands these things, he believes he can optimize the route. So he starts pulling switches. He diverts the train to a faster-looking track for a few miles, then reroutes it again when that section gets bumpy, then pulls it onto a siding when he hears a rumor about a bridge ahead. Every decision feels rational in the moment. Every switch pull is justified with data. But here's the mechanical reality. Every time that train changes tracks, it has to slow down. Every switch has friction. Every reroute costs momentum. When after 30 years, that engineer's train has traveled roughly a third of the distance of the one that nobody touched, the system isn't broken. It was never broken. The switches are the product. Every time an educated investor touches the controls, every rebalance triggered by a news cycle, every fund switch prompted by a quarterly report, every allocation change driven by a podcast prediction, the system collects a toll. Transaction costs, tax events, spread losses, behavioral drag. The train doesn't fail because the track is bad. The train fails because someone smart enough to read the manual thought that meant they were qualified to redesign the route. Now let me show you what this costs in human time, because that is the only currency that actually matters to a family. The median household income in the United States is approximately $83,730 as of the 2024 census data. Let's take a household that earns that income, manages to save and invest about 10% of it per year, roughly $8,400 annually, and does this consistently for 30 years. If that household simply captured the market's historical return of approximately 10% annualized, they'd have roughly $1.53 million at the end of 30 years. That's the freight train with nobody touching the switches. But the DALBAR data tell us the average equity investor earns about 3.5%. At 3.5% annualized, that same $8,400 a year for 30 years produces approximately $441,000. The difference is roughly $1.09 million. That's not abstract wealth. Let me convert that into the unit of measurement that should terrify every working parent. If you earn $83,730 a year and you work roughly 2,000 hours a year, your labor rate is about $41.87 per hour. That $1.19 million in lost wealth equals approximately 26,000 hours of your working life. That is 12 and a half years of full-time labor. That is 1,625 Saturdays. If your child is 5 years old right now, you will have worked every single Saturday of their life from kindergarten through their college graduation and beyond. Not for your family, but to pay the behavioral toll that the system extracts every time you pull a switch because you thought you were smart enough to improve the route. This is not a fee hidden in your fund prospectus. This is time hidden in your overconfidence. This is your daughter's entire childhood, measured in Saturdays you donated to the friction machine because a diploma on your wall told you that you were different from the average investor. And the data say you are not. Here is where we grab the yoke. The plane has been on autopilot, and the autopilot is not malfunctioning. It is programmed to fly in circles while charging you fuel. The manual override is not about finding better investments. It's not about picking the right fund or timing the next correction. It is about structurally removing yourself from the system's ability to extract behavior from you. Kai's framework here is what I call defensive asymmetry. The goal is not to maximize returns. The goal is to make it mechanically impossible for your own psychology to destroy your family's wealth. You do this by building two things: an income floor and an asymmetric protection barrier. The income floor means your family's essential expenses, housing, food, insurance, utilities, are covered by sources that do not require you to sell invested assets under any circumstances. This could be stable employment income, a cash reserve, or a short-term bond ladder that covers 12 to 24 months of living expenses. The purpose of the income floor is not to grow wealth. Its purpose is to remove the trigger. When the market drops 30% and your neighbor is panicking, the income floor means you don't need to touch your investments. You don't need to sell. You don't need to switch. You don't need to pull the lever. And if you don't pull the lever, you don't pay the toll. Asymmetric protection means structuring your long-term investments so that the cost of doing nothing is always lower than the cost of doing something. Low-cost, broadly diversified index funds with expense ratios under 0.10%. Automatic contributions that never stop regardless of market conditions. A contribution schedule that is boring, mechanical, and immune to your opinions. The Pew Charitable Trusts published research in 2022 showing the rolling retirement savings from a 401k into an IRA with just a 0.34 percentage point higher expense ratio. That's the median difference between institutional and retail share classes, could cost a retiree over $20,000 across 25 years. That is one decision made one time, usually at the suggestion of a financial firm's marketing materials, that silently extracts wealth for a quarter century. The Georgetown Center for Retirement Initiatives confirmed the same finding. A fee difference of just 1% can reduce retirement assets by tens of thousands of dollars. These are not speculative projections. These are verified, peer-reviewed calculations based on actual fund data. The educated household is the most vulnerable to these extractions, precisely because they believe they are sophisticated enough to navigate them. Here is the execution protocol, and I want you to treat this like structural reinforcement of a building, not a strategy for getting rich. This week, you stabilize the foundation. You calculate your household's actual monthly essential expenses, not your lifestyle expenses, your survival expenses. Housing, food, transportation, insurance, minimum debt payments. You take that number and you verify that you have a liquid cash reserve equal to at least 3 months of that figure in a high-yield savings account that you do not touch for any other purpose. If you don't have that reserve, every dollar of available savings goes there first before a single cent goes into the market. This is not an emergency fund in the traditional sense. This is the mechanical kill switch that prevents your psychology from destroying your investments during the next downturn. This month, you reinforce the walls. You audit every investment account you own, and you identify the all-in cost, expense ratios, advisory fees, transaction fees, wrap fees on every dollar you have invested. The research from Pew, Georgetown, and the Investment Company Institute consistently shows that the median retail investor is paying significantly more than they need to, often without realizing it, because fee disclosures are written in language designed to obscure rather than inform. If you are paying more than 0.20% in total expense ratios, you investigate whether a comparable low-cost index alternative exists. You make one single switch, and then you set a calendar reminder for 12 months from today, not to review your returns, but to reconfirm that your automated contributions are still running. You do not check your portfolio between now and then. That is not laziness. That is structural discipline. It is the financial equivalent of bolting a load-bearing wall to the foundation so it cannot shift during an earthquake. This year, you build the moat. You increase your automated savings rate by at least 1 percentage point. If you are saving 10%, you move to 11. You enroll in automatic escalation if your employer's plan offers it. The Investment Company Institute's 2025 data showed that 401k plan participants who invested in equity mutual funds paid an average expense ratio of just 0.26%, roughly half of what it was 15 years ago, because institutional share classes inside employer plans are almost always cheaper than what you'll find in a retail IRA. If you are tempted to roll your 401k into an IRA when you change jobs, you stop and you calculate the actual fee difference first, because the Pew data show that this single decision is one of the largest silent wealth transfers in the American retirement system. The moat is not built by making brilliant moves. The moat is built by making it structurally impossible for you to make destructive ones. You automate everything. You reduce all fees to the minimum available, and then you do the farthest thing an educated person can do with their money. You ignore it. In 1973, the smartest institutional investors in the world looked at the Nifty 50 and saw certainty. They saw companies that could not fail, valuations that were justified, and a consensus so strong that disagreement felt like ignorance. Carl Hathaway at Morgan Guaranty called anyone who sold a growth stock the greater fool. Within 2 years, those investors had lost nearly half of everything. It wasn't that they lacked information. They had more information than anyone. It wasn't that they lacked education. They had the finest education money could buy. What they had was confidence, a bone-deep, credential-backed certainty that they understood the system well enough to act on it. And that confidence was the fault line. The system doesn't extract wealth from the ignorant. The ignorant barely participate. The system extracts wealth from the engaged, the informed, the educated, because they are the ones who pull the switches. They are the ones who generate the friction. They are the ones who pay the toll at every junction, because they believe each turn is an optimization. The data from DALBAR, from Kahneman and Tversky, from Barber and Odean, from Pew, from the Federal Reserve's own survey of consumer finances. All of it converges on a single uncomfortable conclusion. In a system designed to monetize your decisions, the most profitable thing you can do for your family is make as few decisions as possible. The fortress isn't built by knowing more. The fortress is built by doing less. And the farthest part of that, the part that will gnaw at every educated instinct you have, is accepting that doing less when you know more isn't a failure of intelligence. It is the highest expression of it.